Hey everyone, welcome back to Corporate Decoder, the place where we break down complex financial documents, so you don't have to get ready because we're diving into the PennantPark Enhanced Income. Fund's latest prospectus, a document packed with numbers that could tell us a lot about where your money might go, and hey, before we dive in, if you appreciate getting these straight to the point. Financial breakdowns, consider subscribing and smashing that like button, and if you want to join a community of fellow corporate explorers, our Discord server, linked in the description below, is the place to be, alright, so PennantPark Enhanced Income Fund. What is the story here? Well, they are essentially an investment company aiming to make you current income, and then some long-term capital appreciation by investing in a rather specific type of asset, the junior debt tranches of collateralized loan obligations, or CLOs. And they're upfront about it. This is not for the faint of heart. They are investing in what is called below investment grade or junk debt, meaning there is a higher risk of default but potentially higher rewards. But what is truly interesting is how they plan to operate this whole interval fund structure and the fees involved. Let's get into the nitty-gritty. When we look at the fees and expenses here, we are talking about the direct costs of putting your money into this fund. And for Class A shares, you're looking at a maximum sales load of 5.75% right out of the gate. That is a significant chunk of your initial investment gone before it even starts working for you. Now, Class C shares have no upfront sales load, but they come with a contingent deferred sales charge, or CDSC, of 1.00% if you sell within 365 days. That means if you need your money back too soon, they'll take a slice. But the real story unfolds when you look at the ongoing expenses for Class A shares. The total annual expenses hover around 2.54%, and for Class C shares, it jumps to a hefty 3.29%. That is a lot of your investment being chipped away every single year. Now, they do have a management fee waiver and an expense limitation agreement in place until the end of 2026, which actually reduces these costs significantly, bringing them down to 1.00% for Class A and 1.75% for Class C shares after the waiver. But this is temporary, and what happens after 2026 is crucial. Class I shares are the cheapest at a mere 0.75% annually. But those are for big investors with a minimum investment of $100,000. Let me show you what this means in real terms on a $100 investment over 10 years class. A shares could cost you around $354 Class C shares, around $371 in Class I shares, are much more palatable $271. This demonstrates the power of compounding costs and why even small percentage differences can add up to a lot of money lost over time. The example clearly shows the impact of those fees and how they eat into your potential returns. So while Class C shares might seem attractive initially due to no upfront load, those ongoing fees and potential CDSC can make them more expensive in the long run. Now let's talk about the risks, because this document certainly does not shy away from them. They are a newly organized fund with no operating history. This is a blind pool, offering meaning you can't see the investments before they're made. And they are very clear that these shares are of limited liquidity, meaning trying to sell them quickly could be difficult and might mean selling at a loss they invest. Primarily in the junior debt and equity of CLOs, which are already risky, and this adds another layer of complexity. They warn that distributions can be uncertain and may come from offering proceeds or borrowings, which is basically your own money or borrowed money, not necessarily from investment performance. This section really delves into the core of why this fund is considered high risk. Their CLO investments are indeed riskier and less transparent than direct investments. The underlying assets are senior secured loans, and when they invest in junior debt tranches, they are in a subordinated position, meaning if things go south, they are the last in line to get paid leverage. D credit risk is a major concern here, and the lowest tranches bear the highest risk. They mention the potential for interruption and deferral of cash flow due to certain ratios not being met, which could put a halt to distributions. They also admit they may invest in assets with no or limited performance history, which is always a red flag. And then there is debt financing. They may incur indebtedness to make investments, which magnifies potential gains, but also losses. This leverage can make the fund's net asset value per S-hair much more volatile. It is a double-edged sword. They're using borrowed money to try and boost returns. But if the investments don't pan out, that leverage amplifies the losses drastically. Looking at the management team, Arthur H. Penn is the founder and managing partner, and he has been in the industry for over 30 years. The independent trustees are there to provide oversight, and they have audit and nominating corporate governance committees, which sounds standard. But it is important they are truly independent and not influenced by the advisor's compensation structure. The compensation of portfolio managers is tied to salary and discretionary bonus, which includes performance fees. This structure is designed to align interests, but it can create an incentive for taking on more risk to generate higher fees, which is something to watch out for. They also disclose that the portfolio managers manage other funds and assets, which means their time and resources. are divided. This is a crucial section because of the potential conflicts of interest when the advisor identifies an investment opportunity they might have to choose between this fund and other funds they manage. This could lead to situations where one fund gets a better deal than another. The fund may engage in investments with affiliates, but this is subject to strict conditions and oversight from independent trustees. PennantPark votes proxies in what it believes are the best interests of its clients' shareholders. They have procedures in place to identify and address conflicts of interest when voting proxies. For example, if there is a business relationship that could sway their decision, they might disclose it to the client or use recommendations from independent third parties. Now, for my take on all of this, PennantPark Enhanced Income Fund is investing in a very niche and high risk area of the market. The focus on junior debt tranches of CLOs means they are essentially betting on the performance of underlying loans, which are already considered below investment grade. The fees are quite high, especially after the initial waivers expire, and that is a material factor for any investor. The limited liquidity is also a significant drawback, meaning you can't just sell your shares easily. If you need cash, the fact that they are a new fund with no operating history adds another layer of uncertainty, while the management team has extensive experience in this sector, and they do have a waiver in place for a few years. The inherent risks of the underlying investments, coupled with the fee structure and limited liquidity, make this a very speculative investment. It is not a buy and forget kind of situation. It requires a deep understanding of the risks involved and a very long-term investment horizon. For most investors, I'd say this fund likely carries too much risk for its potential reward, especially when you consider the fee drag over time. So what is the verdict? A high risk high? Reward play certainly not for everyone. The story here is one of specialized investing with potential for attractive income. But overshadowed by significant credit risk and elevated costs, it is a fund that demands a lot of due diligence from the investor to understand the full implications. Alright, that is our breakdown of the PennantPark Enhanced Income Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description, and as always, thanks for watching. See you next time.